Good morning and welcome to today's event. My name is Mark Mazur. I'm the Robert C. Posen Director of the Urban-Brookings Tax Policy Center. And it's a real pleasure to welcome you here today to Brookings Institution for a discussion of an important tax issue, possible ways to tax capital income, including mark-to-market proposals. We have two stellar panels today to discuss the issue, and a wonderful keynote speaker who I'll introduce in a moment. First, I'd like to cover just a couple of housekeeping items. First, Tax Policy Center is pleased to welcome you all here in person. Also want to welcome our online audience and appreciate your attention. For those who want to extend the discussion on social media, the hashtag Taxing Capital is being used up on top, and that'll help keep the conversation going effectively. And we've built in time for audience questions and answers throughout today's program. When we get to those parts of the program, there'll be microphones circulating the room. Wait for a microphone, introduce yourself, ask your question. It makes it easier for people in the room to hear you, but it's essential for people online to hear you to have the microphone. That said, let me turn to introduce our keynote speaker. We're incredibly pleased today to have Representative Jan Schakowsky here. Congresswoman Schakowsky represents the northern part of Chicago and northern suburbs. She has a long-standing interest in fiscal policy. She served on the Bowles-Simpson Commission earlier this decade. She's very interested in economic and fiscal policies that work for all and that would help restore a vibrant middle class. One thing I appreciate about Congresswoman Schakowsky is that she knows where she comes from, she knows what she believes, and that's what she tries to do in her job. So I'm incredibly happy that she chose to spend some time with us today and discuss some important policy issues. So join me in welcoming Congresswoman Schakowsky to the stage.
Thank you, Mark. I'm really pleased to be here today. Happy to see people who are interested, in addition to impeachment, something else that affects a lot of Americans. So this is a moment, right? This is a moment in history. I think it's a real inflection point right now. We know, of course, that income inequality is spiraling out of control, that working families are paying the price. But what's different, I think, right now are changing attitudes and politics around the issues of income inequality, which, of course, include tax policy. I think this is a moment where more and more people feel free to say we should be taxing the rich. I think there was a time not too long ago where the idea of tax the rich was viewed as just as some sort of radical lefty kind of idea. But I think now the politics has really changed, opening the door for new legislative proposals, for a different tone of discussion. So, of course, without question, the tax system contributes to our growing economic inequality that is destabilizing our economy, threatening our democracy, and also mobilizing a lot of pissed off voters. Furthermore, woeful inadequate tax revenue is leading to chronic and corrosive underfunding of vital programs and services, including all the way up to Social Security and Medicare and education and housing and infrastructure, and the need for a rapid response to climate change. But I really believe that change is coming. Of course, elections really matter. But I do believe, in any case, that change is coming, that reforming the taxation of rich people's capital, income, and the subject of this, which is, of course, the subject of this conference, would begin to address the problems that we're facing today. So this is the richest country in the world at the richest moment in history. And the richest 1% of Americans own more wealth than the bottom 90%. And what's more, the richest 1/10 of 1%, about 140,000 taxpayers, hold more wealth than the bottom 80% of American households. And the most startling to me, the three richest white guys, Jeff Bezos and Warren Buffett and Bill Gates, are collectively worth as much as the entire bottom half of American society. So just think about that for a moment. We are really out of sync right now. And this grossly distorts the economy, also weighs on our democracy itself. It really allows outweighed political strength to those who have the money. In 2012, the richest 1% gave 42% of federal campaign donations. And during the 2014 cycle, just 32,000 donors provided nearly 1/3 of all the campaign donations. And in 2018, the top 100 donors gave a total of $800 million, or 14% of the total donations. I mean, if you thought you were going to get away with not hearing about the politics of all this, you're wrong, because it does distort and diminish our democracy when you have that kind of skewing. By the way, the 2018 donations included $123 million from Sheldon Adelson and his wife, and $95 million for perhaps presidential candidate Mike Bloomberg. And those are the kinds of numbers that certainly get your phone calls returned when you're one of those big donors, and that really elbow out the concerns of average voters that can't afford to pay for the attention that they deserve. But again, I think that is really changing. We're seeing an electorate that is up in arms. This is a moment when there is more mobilization of people than we have seen in recent history in terms of political awareness and political activism. So meanwhile, the world where while the rich are getting extraordinarily richer, the rest of Americans live in a world that is literally crumbling. If we don't get an infrastructure bill, we are in deep trouble right now. The public investment has been shrinking, and we are really facing the consequences of these shortcomings. We need about at least $2 trillion to rebuild our failing infrastructure. We need another $2 trillion to create affordable child care and better housing. We need about $1 trillion to make public college free, which can be done, and reduce student debt. $500 billion would improve the Affordable Care Act, and on and on. I could go on and on. And these are needs that need to be addressed now. People are feeling it critically. And we need around $3 trillion to make an even modest down payment on very bold ideas like the Green New Deal or Medicare for All. So, as I said, the list goes on and on. There's about $10 trillion over 10 years that we need, not counting what's needed, as I say, for Medicare for All or for something as bold as the Green New Deal. And so I think the time is really up for the super rich, and it's really time to be talking about how we are able to tax these the capital that they have. And there's many ways to approach it, but I want to tell you that we are hearing the whining right now of the billionaire class. I just want to give you a couple of examples. Bloomberg has postulated that it's unconstitutional to do that. I just want to say that I think that the property tax actually is a wealth tax, except that it affects ordinary Americans. You value the property of the house, and then you tax it, and it's the biggest middle class asset, and I think it's a wealth tax. Zuckerberg said it hurts philanthropies and scientific research, and that it gives government too much decision-making power. Imagine. Government, too much decision-making power. We have Bill Gates, who mused about the impact on the incentive system for making money. But you should know that Microsoft actually started in 1975 when the top tax rate was 70%. So I think there's a little bit of hypocrisy there. And I don't know you probably know who Leon Cooperman is. I don't know, he's a really rich guy. He actually on CNBC choked up when he was talking about the impact that a wealth tax, that a tax on his would do to his family. So, let's pass the hat for Leon Cooperman. So there are a number of ways for achieving a fair share tax that works for everyone. And I am, along with my partner, Representative Ocasio-Cortez, will be soon offering a possible approach with a revision of my Fairness and Taxation Act, FIT Act. And the new FIT will have several components, including raising the individual tax rate. We're talking about a highest tax rate of 59%. If you add state and local taxes, if you add Medicare taxes, it ends up with about a 70% tax. But the part that's most relevant to our discussion today is our proposed reform of capital income taxation. So we begin by correcting what is perhaps the most glaring injustice of the tax code. The giant tax loophole that gives preferential treatment to income from wealth over income from wages and work. By taxing capital gains and dividends at a much lower rate, we send a signal to the public that says that a stock market speculator is much more important than a nurse or an electrician. Under the Fairness and Taxation Act, that is going to change. No longer will it be possible, as it is now, for a Wall Street billionaire to pay a lower tax rate than a median wage earner in our country. Under our legislation, all the investment income of the wealthy, including long-term capital gains and qualified dividends, will be taxed at ordinary income tax rates. But as this audience knows, reforming capital taxes isn't that simple. You can't just equalize rates and expect to raise a lot of money, the kind of money that we need. There are still too many loopholes for the rich and shield their income from fair taxation. And that's why our legislation will make other reforms that, taken together, will make it difficult for the wealthy to dodge their fair share of taxes on the money that they make from their wealth. The legislation will tax capital gains annually, not just when the appreciated asset is sold. The conference title uses the term mark to market. I actually think it's a little bit more understandable, and I prefer to call it the pay as you profit, but it's the same idea, whatever you want to call it. One estimate found that U.S. households had $3.8 trillion in unrealized gains in stocks and investment funds and at the end of 2017. And that didn't include the gains that had in that they may have had in real estate or private businesses or artwork and other non-tradable assets. The Federal Reserve found that unrealized capital gains make up most of the value of estates worth more than $100 million. So asset appreciation can be understood really as wages from wealth, but unlike wages from work, which are taxed every paycheck, all through the year, every year, assets of the wealthy can appreciate year after year, decade after decade, without a penny of taxes being paid, if the wealthy play their cards right. Our Fairness in Taxation Act would fix that so that wealthy investors pay as they profit, just as employees pay as they earn. So it's important to note that our pay-as-you-profit tax would only apply to future capital gains. That would leave trillions of dollars in untaxed gains accumulated before the law went into effect. So we're going to need some help here. We will need a transition tax for those past gains without and right now we don't really have the wording on that, so I would invite anybody here, you're the experts here, to help us figure that out. As part of the reform, we would close the loophole that allows wealthy families to avoid paying income tax on capital gains when they inherit assets. Any untaxed gains would be taxed at the time of inheritance, and as would any untaxed gains on gifts when the asset changes hands. That's another important piece of this legislation. And all in all, the capital gains tax reform that will be in our bill could probably raise, we figure, something like $2 trillion, maybe even more, and hopefully the scorekeepers at the Tax Policy Center will be able to give us an estimate. I think, as you can probably see, I am not the expert on this, but you have to deal with me because we do the legislation. And so I'm hoping very much that we're going to get assistance from the experts that are here in the room. It's really gratifying to see that right now so many Democratic candidates for president have embraced the concept of capital tax reform. For instance, all of the top-tier candidates have endorsed the idea of equalized capital gains tax rates with ordinary income tax rates, of taxing wealth like work, and at least 3 are now on the mark-to-market bandwagon. Senator Warren, Mayor Pete, he's in my neck of the woods, and Julian Castro. And as this event will reveal, there really are many ideas for how to best tax wealth and the income from wealth. 3 leading ideas, I think, are really on the table. Annual wealth tax on great fortune, pay as you profit tax on unappreciated capital gain, and such as such as I proposed, and standalone bills of all different sorts that we're looking at right now. But I want to tell you, having conversations about this is important right now, but I think equally important to show the American people that we're really serious. We want to put legislation and language in place. Do I think that bills like this are going to pass right now? Do I think even if we pass the House of Representatives, that it's going to pass in the United States Senate at this time? Unlikely. But we need to send a vision to people of what equity in taxation can actually look like. And I think that involves more than just discussing these various proposals. I think it's really important to put them down in legislation. And then we can discuss the difference, we can fight over the differences, the best way to approach these things. But so I want you to think about how we can work together. This is, our bill is just one example. Of course, Elizabeth Warren has the wealth tax that I think is gaining strength. And as I said to start with, I really do think this is a moment for change. That people have been suffering under these inequities in the tax system for such a long time. But now it's being talked about at meetings of groups named Indivisible, of neighborhood organizations. People are rising up right now and saying, we want this kind of change. We are not going to continue to see the rich get richer and all the rest of us get stuck on the bottom. So I really invite you to be active participants, to share your ideas. My staff, Sid Terry, is here that works with us on this. Congresswoman Ocasio-Cortez is an active voice. Hey, when you've got over 1 million, followers, you got a lot of power, but also very smart about how to move forward. So join us in this effort to put to paper the ideas that you have and help us perfect ours. Thank you so much.
So if you have we have time for a couple of questions, so if people have them, please raise your hand. We'll get a microphone over to you. Way in the back.
You'll have to excuse me, I'm young and uneducated. So my understanding, and I am by no means an expert in tax policy, is that the 16th Amendment of the Constitution was required to implement an income tax. How is wealth tax or any variation of taxation on standing income or wealth, wrong terminology, I suppose, allowable under the Constitution by the federal government?
That's why I raised the question of the property tax. Unlike the income tax, where ordinary people see their property valued, given a number. This is wealth. It's considered wealth, and it is taxed. And it is the number one asset of middle-class people. And so I would say if the property tax is legal, then certainly taxing capital wealth is also legal, and that we should not, just leave a wealth tax for middle class folks, or I guess wealthy people pay property taxes as well.
Hi, thank you. My name is Deborah Ray, and I'm from the University of Maryland.
University of?
University of Maryland.
Okay.
I just graduated with a master's degree in applied economics.
Congratulations.
Thank you. My question is, can you talk to me more about your plans to create a progressive wealth tax? Because, with fintech, millennials especially are taking greater control over their retirement savings. And so I'm wondering how an increase in the capital gains tax will affect that.
We actually have an exemption for people who have less than, what is it, 5 million? Built into the legislation, we actually do set a level at which we would not have this tax. So, I could look it up right now, but,
Yeah.
we take that absolutely seriously and into consideration. Good question.
Fantastic.
Joe Bettesele, Coalition on Human Needs. Part of this idea of reforming the tax code is to provide equity for our society, but the other part is to generate the revenue that we need for our
Correct.
society. Could you elaborate on, or would these measures, if magically tomorrow they appeared, enacted into law, would this generate the amount of new revenue that we actually also need to also, on the other half, create a more equitable and just society?
Yeah, I mean, I think I said those two things, that the tax code is unjust and that we are desperately short of the revenue that we need. Would this bill do it all? Would any piece of legislation do it all? But if we think that it would generate, we think a minimum of $2 trillion, that's pretty good. That's a good start and could do a lot of really important things.
Thank you very much. I'm Bob McDermott. I'm a retired lawyer. Just out of curiosity, though, in the mark-to-market concept in your bill, it makes some sense to me to tax unrealized gains. But what do you do when there is a recession or a depression and those unrealized gains are lost? Does your bill propose for paying the tax back, a negative tax?
Would we refund the tax?
Yeah.
No.
Okay.
Hi. Very interesting. Quite two points. You do know, of course, that there were 13 countries in the world that had a wealth tax, and only 3 are left now.
Can you speak a little bit?
There are 13 countries in the world that used to have a wealth tax. Only 3 are now left, one which being France. France have now reduced their wealth tax just to property, and they did an analysis in 2016, and Macron got rid of this wealth tax because it was on everything. They decided they raised 3.7 billion a year in the wealth tax, but the GDP went down by 7.5. So in fact, what happens is, and you haven't calculated this at all, is wealth tax is one thing, but the reduction on GDP on the other side usually wipes out any benefit from the wealth tax, plus costs the country more money. You have the most entrepreneurial country in the world, and you're about to destroy it. Thank you.
As I pointed out, when we were at our highest levels of taxation, we saw some of the most innovative work being done. No, that's not true. Between 19, so I just looked it up too, between 1965 and 1981, 70%. Between well, we also had, at a pretty innovative time, 91% since 1954 to 1963. Yeah, that's true.
Capital gains is 28%, income tax is 70%. In England, when I was there, we had 93%, 98% roughly. The capital gains tax was
I've been doing this for 40 years. I do know this.
Okay. Okay. Okay.
One last question over on this side of the room. Got a microphone coming your way? Oops,
Thank you so much for your vision. 5 years ago, after reading Thomas Piketty's book on capital, I started a project called the Center on Capital and Social Equity, which is trying to help the bottom half become included in our capitalist economy. And it's been lonely, so I really appreciate what you're doing. I've just finished reading Triumph of Justice by two of Elizabeth Warren's, The Triumph of Injustice by two of Elizabeth Warren's advisors, where they're laying out a vision for a tripartite tax on the wealthy. Corporate tax,
Right.
a wealth tax, and an income tax.
Right.
But they're actually, one of their objectives is Europe. And they're saying that to get the money we need for a socially fair society, Europe uses a VAT tax, value-added tax, which is a consumption tax, which is very regressive and hurts the poor. So how do you see this as a better option than a VAT tax?
Yes, absolutely. I think.
Sorry about the long
As you
question.
said, the main drawback of that tax is that it's regressive, and it's time in this country with the income inequality that we have that we go after that money at the top. Yeah.
Please join me in thanking Congresswoman Schakowsky.
Thank you.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.